Hi everyone, welcome to this new session of CFA Level 2. Today we'll be starting with a new reading for equity portion, which is multiples based valuation. Now in the multiples based valuation, you do have some reference of it from level 1 itself. Primarily, we are talking about the price based multiples. So you had four ratios: PE ratio, price to earnings, then price to book, price to sales, price to cash flow. All four of those ratios are going to be in a little more detail here. Primarily allowing you to estimate the price of the company, or what should be the price of the company ideally, in another way aside from the free cash flows and dividends based valuation that we've already done. Now, aside from these four price based multiples, you also have two other ratios which are going to be covered extensively here. One is the dividend yield, which is simply dividend divided by the price. So we can sort of adjust that formula around. If we do some mathematical adjustments, we can also use that formula to estimate some sort of price indication. And the sixth formula is again a repetition from level 1, which is your enterprise value based multiple, the EV by EBITDA multiple. So we'll be using all of these to try to estimate what the price of the company should be under ideal circumstances. Now, before we get into the introduction part, I do want to clarify one thing right away. This reading is going to be very unique in terms of these sessions, primarily because I will not be taking them in the same sequence as the topics are provided in your curriculum. We will be covering all the topics, be assured of that, so you don't have to worry about missing out on something. But what we'll be doing is we'll be focusing on one formula or one particular metric, and then we'll be covering all the content regarding it. So in your curriculum, they have first given you the PE, PB, all these ratios, and then they have moved on to justified ratios, and then there are some other topics which relate to different ratios. So instead of going in that flow, what I have done is I've structured this session in such a way that we'll be doing PE ratio first, price to earnings ratio, and we'll be covering all the details that are there to cover regarding that ratio. So in this first session of the reading, so yes, there will be two sessions to this reading as well, fairly small sessions, not lengthy sessions. But in the first reading, our primary focus would be on the PE ratio. So that using that ratio itself, we'll be looking at some calculations, some formula. But aside from that, a lot of concepts that are applicable to every single ratio in this reading, we'll cover them today itself by looking at the price to earnings ratio so that we don't have to repeat them again and again for each ratio. And in the next session, we'll be covering the remaining portions of this chapter. So with all of that out of the way about the structure of the sessions for this particular chapter, let's start with the introduction part. Now, the basic idea behind multiples based valuation is that we want another alternative aside from cash flows, aside from dividends, so that we can estimate the price. Now, the reason why we might need all of these alternatives is because if you think logically, some companies pay dividends, some might not. So, as such, dividend based valuation is not always applicable. Free cash flows, yes, the companies who are into operations, they will have free cash flow. But the bigger problem with free cash flows is that free cash flows have to be calculated, which means you have to go through the entire financials of the company, you have to go through all the cash flow details, you have to adjust the income to make it match with the free cash flows. There's a lot of mathematical adjustment which requires a lot of knowledge of financials, which not every investor is supposed to have. So we need some basic techniques which any investor can use. And that is where the need for price multiples arises. Basically, if you look at any sort of share or stock on the market, it has a price, it has EPS listed on your stock exchange portals itself. So just like we had dividend, the EPS is also listed right there on the stock exchange. You don't have to go through the financials of the company. The EPS is something that you can find readily. So some of these ratios become very easy to use. The idea is fairly basic. The entire concept of this chapter, the multiples based valuation, it works on what is known as law of one price. Law of one price says that if two assets have similar characteristics, their valuation should be same. So effectively, if in the same industry I have two companies, on the same scale, everything is same between the two companies. If both of them are earning 10 rupees per share, both of them have EPS of 10, both of them should also have the same price. That's the entire logic of this multiples based valuation, that if two assets are having similar characteristics, their valuation should also be same. And this law of one price further extends by the way of suggesting that if there is a difference in characteristics of two companies, that difference should be reflected in their values on a proportionate basis. So if one company is earning 3 times as compared to the second company, that first company's valuation should also be 3 times of the first company. So the logic here is simple. If the characteristics are same, value should be same. If the characteristics are different, that difference should proportionately reflect in the valuation of the companies as well. So that's the entire logic of multiples that we'll be covering. Now, before we actually look at the ratios and the formulas that we have in this particular reading, it is very important to understand that for calculation purposes, we can have two possible alternatives. One is known as method of comparable, the other is known as method of fundamental forecast. Now, there is a very key difference, and just for the sake of reference, I am going to take PE ratio because this is something that from level 1 you will have a reference of. This is simply price divided by EPS. So price per share divided by EPS. Now the difference between these two methods is that in case of method of comparable, it is actual market price divided by EPS. So over here, my reference of comparison becomes the actual market price of the security in the market. Whereas in case of fundamental forecast, this is intrinsic value divided by EPS. Now, how do we get this intrinsic value? Well, we've done free cash flow based valuation. We've done discounted dividend valuation. In all of those cases, we got some value. That value was intrinsic, that what ideally the share price should be. If I'm using that intrinsic value for the multiples, that's the method of fundamental forecast, which means the price that I'm using for my multiples, that price has been estimated on the basis of some cash flow based forecast. What future dividends would be, what future cash flows would be. Whereas in case of method of comparables, I'm not using any future forecasts, rather I'm just looking at actual market price right now. Now, the reason why both of these are relevant is because throughout this chapter, there is going to be a concept of overvalued, undervalued, which is going to work exactly the same way it has done in the last two readings. If the share price is $50 and I think ideally it should be $40, the share is overpriced. It is more expensive than what is worth. That same logic would extend here also. The only difference is sometimes you could get questions which would not give you information about market price and intrinsic value. Rather, they will just give you the fundamental PE ratio and the standard PE ratio. And then they would ask you to decide if the stock is overpriced or undervalued. And as such, make an investment decision. So just a basic example to clarify that. So over here, I have three values. The market price, the actual market price is $50. Intrinsic value calculated as per, let's say, free cash flow based valuation, $40 and EPS of 10. If I calculate PE ratio using market price, this PE ratio comes out as 5, 50 divided by 10. And if I calculate PE ratio based on fundamentals, this would come out as 4. Now, this F is just for denotation. It's not a standard notation for this. Both of them are calculated as standard PE ratios. Now, if you look carefully, if I have this market price given, I can directly see that the intrinsic value is 40, market price is 50, the share is overvalued, you should sell. But it is possible in exam that you don't get this information about intrinsic value and market price. In fact, the question can just give you these two values and then have you decide whether the company's share is overvalued or undervalued. So you can use that decision here also, that if the forecasted fundamentals, if PE for forecasted is less than standard PE, then the stock is overvalued and you should sell. And if the fundamental based PE is more than the actual PE, then it is undervalued and you should buy. So this is the same logic of overvalued and undervalued that we've had all along the previous readings. I've just rewritten it in the form of the ratio itself. Now, instead of earnings, you can have book value, you can have cash flows, all of those are possible. So throughout this chapter, wherever we have a generic topic, I will be taking an example of PE ratio, but you can replicate the same idea in any other multiples that we have. So I hope that clarifies the basics of the multiples based approach. Let's start with the major point of discussion for today, which is going to be the PE ratio.